Welcome, everyone, to the Daniel Krug and Associates Wealth Management Review for September 2024. My name is Rocky Istvan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. Daniel Krug, CEO and Senior Wealth Manager, will be joining me in today's presentation. Today's agenda will be going over the current economy and markets, where we are at here in September of 2024, and a review of the Tax Cut and Jobs Act that we started last month. So if you haven't seen that, go back to part one and review that, but we're going to be continuing that discussion today.
Yeah, there's a lot of information on the Tax Cut and Jobs Act. I mean, we went through 3 last time, and we'll kind of get into it. But we're going to go over another 4 key areas today, which are going to affect everybody. I mean, it's impactful.
So it's good to see both parts. If you want to put it together, we have clips out there available.
Yes.
On that. So why don't we get started?
Let's hit it.
Okay, so let's talk a little bit about where we are in the market year to date. As you can see, the S&P through the middle of September is actually up for the year 18.1%. And the bond market, which I had talked about last month, has made a recovery. It had been down for years and actually was still negative going into this year, but has started to rebound and move forward and is up 2.8%. As you can see in my comments here, there's been a lot of volatility in the equity markets. Even though we are up considerably for this year, we did see a drop-off, a sell-off at the end of August there coming into this September, but the markets seem to have recovered pretty darn well moving into the second week and into the middle of the month. The Fed has this week cut rates 0.5 point. This is the first time this has happened in a long time. I'm going to touch on that in a minute here. It came in a little higher than some of the expectations. It was expected somewhere between 0.25% and 0.5%. They did the 0.5%, so it was at the higher end. And as I pointed out, bonds are continuing to rally as a result of the anticipated interest rate cuts, and they are up 1.8% so far in this September. Also, what we've been noting is the inflows of funds into longer duration bonds that began earlier, like 2, 3, 4 weeks ago, is continuing. More money moving out of cash, trying to capture those higher rates on longer duration bonds as the bond market is starting to normalize. When we look at some of the sectors within the S&P, you can see here that technology still is kind of leading the pack. Year-to-date return at the top is showing a little lower than what I just showed you because the market is actually up in September. This is the end of August numbers, but it just kind of gives you a feel where the returns are coming from. So technology is leading the pack. Most of the broader market, as you can see through the different sectors, has recovered and is moving forward with double-digit returns this year. However, a few are lagging. And the biggest still is energy. We have not seen huge increases at the pump, but real estate has recovered. A lot of good things going on as this broader market rally continues through September of this year. You know, a lot of people were concerned at the end of August. We had a pretty sizable sell-off, about 8%. Basically, it was at the same time that we had that cyber attack that impacted a lot of companies that used CyberStrike for their security, including the airlines. I know people got stuck traveling because the airlines' scheduling systems were all down and so on and so forth. Here's the top reasons basically behind the market pullback. The economic growth into next year. They're concerned as the economy is slowing. Is it going to be able to sustain solid growth into next year? The tech company prices of their stocks is at all-time highs relative to their earnings. So there's a concern there. The yen carry trade, that would take a little while to explain. You can look it up, but it's basically hedge funds and other investors borrow money in yen and convert it to buying instruments in the United States, money market CDs, stocks, bonds, things like that. Well, Japan raised interest rates, which caused those hedge fund companies to sell off, which was part of why this market dropped Another issue was the systemic funds selling pressure. Basically, what that is there's funds out there that track the VIX or have certain technical signals that say, hey, you've made a profit, it's time to sell. It seems like all those things came together at one time and caused that sell-off. However, remember I said the market has pretty much recovered that here by the middle of September. As we talked about a couple slides ago, the Fed has reduced their funds rate from 5.5 down to about 5 at the upper limit. When you look at this chart, you can see way back in 4 years ago where interest rates were at in the low 2% range, the Fed funds rate. It went to 0 because of COVID. We had to fight our way out of the economy shutting down. But then inflation came in, and you can see how fast the Fed ratcheted up their funds rates all the way up to 5.5%. We finally are starting to see some relief there, and I think that's going to bode well for the markets, including the bond, the stock and bond markets both moving forward, kind of creating more of a normalized stock bond mixed portfolio return that we are accustomed to in the past. When we look at the economic speedometers, we've seen some improvement in monetary policy in the yield curve. Like I said, longer duration bonds are coming back in favor. That is good for the yield curve. That shorter term rates are actually lower than long-term rates. We're not quite there yet, but it's moving in the right direction. And interest rates, the Fed's cutting rates, and we expect more rate cuts, another 0.5 point by the end of the year. The business outlook is looking pretty darn good. And on the right side, you can see where we were in January. So you see green, which is a positive trend in the economic leading indicators. Let's just summarize kind of from last month where we are this month as far as the expectations and forecast for GDP growth, the top line there. We have revised the 2025 growth estimates down a little bit, about 0.25 point. We were at 1.75 to 2.25. You can see the red highlighted area there. So that's been a little bit of a reduction. However, we've improved what we believe the CPI or inflation rate is going to be for the year. So we revised that down, which is a positive. That's why it's green. The Fed fund rate, they've started moving things down. So you see that green, that's a positive. And then what I was talking about, bond rates are normalizing. So your treasuries, we believe, we're seeing a little bit of improvement there and forecasting improvement going into 2025. So pretty quick summary, but
yeah, well,
a lot of positives.
Yeah, there's a lot of good things that are coming out of that. So, it's the old adage, make hay when the sun shines.
Right.
And the sun's shining right now relative to the economy. So, let's just hope it keeps moving. And realistically, it looks like Powell, over this whole process, and this is kind of unprecedented with the economy shutting down like it has. Yeah. It does appear he's doing a pretty darn good job of keeping things stable. Mm-hmm. And let's just hope he continues. And there's no reason to think he won't relative to making the right moves.
Right.
50 basis points, I was thinking it was going to be more like 0.25,
right,
on the lower side.
Yeah, they came on the higher side.
Yeah, so let's see how that works out.
Yeah, and if they cut another 0.5 point this year, I mean, that should start to impact mortgage rates, loan rates. As banks are borrowing from the Fed at a lower rate, they
Correct.
can in turn, provide loans at a lower rate. So that could help spur the economy a little bit. Absolutely. Next year.
And, just looking at things short term for the market, yesterday it started out high, ended up on a loss. Not a big one. I think we were down like 0.25 point or so. The futures for this morning are up. Mm-hmm. A little bit. I think it's like 40 basis points for the S&P. Mm-hmm. So we'll see how things turn out. But this is short term. We're in it for the long term. So we're not making any kind of knee-jerk reactions in the portfolios or anything like that.
Right.
But we do need to be looking towards the future and what's coming down the road potentially from a tax standpoint. So let's go ahead and get into the next segment here on tax mitigation concepts. And what we're talking about is the Tax Cut Jobs Act sunset. And this is part 2. Part 1, we went through 3 items and we'll talk about those. But let's get into a little fun fact first. The first income tax in the United States came about with the Revenue Act of 1861. Now, we kind of learned that in webinars before, where President Lincoln was the actual first president to bring in a federal income tax. And that was a 3% tax on income above $800 well, that doesn't seem like much, but back then it was a lot. And it was used to fund the Civil War.
You actually used pennies back then to buy things.
Yeah, well, yeah. Yeah, now pennies are a relic.
Yeah.
So the question here is what year was the tax repealed? Any guesses on that? It goes back a little ways.
No.
Well, it was actually 1894. And the federal tax, it was a flat tax, was ruled unconstitutional by the U.S. Supreme Court. Now, one might ask, if it was ruled unconstitutional, why the heck do we have a federal tax now? And we'll get into that one on the next webinar. So let's move forward. Looking at the top federal tax brackets again, we learned that the average over between 1913 and 1924 has been about 56%. And you can see that over time, presidents have increased the taxes and they have decreased them. And it's kind of been a seesaw over the last couple decades, where the first Bush had a tax increase. He first had a tax decrease, then he went to an increase. That's kind of what ruined his presidency then. Clinton came in and raised the taxes up to 40% for the highest marginal. Young Bush came in and lowered it to 35%, and then Obama came in and raised it to 39.7. Now, I don't know whether he just wanted to stay below Clinton by a little bit or what, but I'm not sure where that 0.3 came from. And then we've all had the luxury of a 37% highest marginal tax rate when Trump put in the Trump tax cuts. And this is kind of critical because we're going to be going back to the Obama tax increase. So when we talked in the last webinar, we talked about how estate and gift taxes, there's going to be a sizable increase in the amount of taxes that are going to be paid because your estate tax equivalent is going to be reduced substantially. We talked about income tax brackets where the rates are going to go up. But probably equally as important, and maybe even more important, is the thresholds are going to be adjusted. Many of them adjusted down severely, where people are going to be thrown into higher tax brackets. And then you have the standard deduction, which again is going to be about cut in half. Now, that one, depending on whether you're single or if you have a lot of kids, the changes are either going to hurt you a little bit or help you. And what do I mean by that? Well, if you go to number 4, the personal exemptions, prior to the Tax Cut and Jobs Act, a taxpayer could claim $4,050 as a personal exemption for themselves, their spouse, and each of their dependents. So the Tax Cut and Jobs Act actually eliminated the personal exemptions, but the sunset of the Tax Cut and Jobs Act will bring it back and it'll be adjusted for inflation. So again, if you're a married couple, you'll pick up, depending on the adjustment here, over $8,000 for a personal exemption. But again, you're going to lose the standard part of a good portion of the standard deduction. So that could be a net negative for you. But if you've got several children, dependents, it could be a net positive. The next one is really more, this one I don't think is going to affect too many people. Currently, taxpayers can deduct the first $750,000 paid on debt for their purchase of substantial renovations, primary or secondary residential homes. However, then at this point, when the Tax Cut and Jobs Act ends, it will actually go up. Again, I don't think it's going to affect a lot of it. It's not going to affect me because I don't think I'm going to be paying that much in debt on a mortgage. So this one's really a talking point that talking heads might throw out there, but it's not going to affect the average person out there. And I just wanted to put that in there. Number 6, the PACE limitations. The PACE limitations was a reduction on the total amount of itemized deductions for high income taxpayers. It reduced the amount of the deductions by 3% of the amount by which the taxpayer's income exceeded the threshold set by the Internal Revenue Code. And it was basically capped at 80% of the total value of deductions. And effectively what that means, if I had, we'll say, $100,000 in deductions, I would effectively lose 20% of that based on the limitations here. So this is what it will revert back to after the Tax Cut and Jobs Act expires. And when you look at the numbers here, the limitation will return the taxpayers above a set income threshold, which in 2017 was $261 for singles, $313 for married couples, will have their deductions phased out. So this is just another way of taking your income and moving it into a higher bracket for higher income earners. Now, when you look at these incomes, some of us say, yeah, I'd love to have income like that, but there's a lot of people in that income area that are going to get affected by this. And then number 7 is it's going to affect business owners for sure, because it's going to directly affect them. That's the qualified business income deduction. And it's also going to have a trickle-down effect to the rest of the economy and other taxpayers. And this is kind of how it works. The Tax Cut and Jobs Act introduced a new deduction specifically for pass-through businesses. Now, that's companies like LLCs, partnerships, S corporations, and sole proprietors. And I'm here to tell you there's a lot of individuals who will fall into this category. In 2024, a single filer under 191, call it 192,000, and joint under 300, we'll call it 84,000, can deduct 20% of their qualified business income. That's a big deal. When the business owner's income exceeds the threshold, the deduction is limited, subject to formulas based on what type business they have. So what does this all mean? It means that when the tax cuts came into effect, when Trump put them into effect, he did it to really spur the economy. And basically what the small business owners did, they started hiring people because they had more profit on the bottom line. They did remodels of their companies. They did retooling. It was something that really did spur the economy. Now, the concern for everybody is if they rescind this, which the sunset will do, they're going to basically be increasing the tax liability for businesses currently taking advantage of it. Now, how does that affect the economy? Well, quite frankly, if a business loses 20% of their bottom line and they need to pay the tax on it, they're going to have less to reinvest in the business. What does that mean? Could mean layoffs, could mean that they don't retool. It isn't typically a net positive for the economy as a whole. So that's one of the reasons it was put into place in the first place, was to boost the economy. So we'll see how this kind of plays out, but it is on the chopping block for the repeal in, less than a year and a half now, Rocky.
Yep, end of next year.
Yeah, end of next year. So these are the 7 key areas that we talked about in last webinar and this webinar. They are going to make a significant difference. This is where your tax mitigation strategies are so important, because when the Tax Cut and Jobs Act does sunset December 31st, 2025, most people are going to be paying a lot more in taxes and going to have less to spend. So if you have not done a tax mitigation strategy, we've got 2024 and 2025 that you can actually take advantage of getting yourself set up, at least somewhat, before it sunsets. So, at this point, somebody out there that owns a business, somebody out there that hasn't done any tax mitigation, I would absolutely talk to them about it. Refer them to us. We can have a meeting with them, see what we can do to put them in a better position come 2026. But this is a big deal.
Yeah.
You know, we said it was coming. It's been staved off a little bit. I'm not hearing anything or reading anything that says this is not going to go through.
Yeah, it's easy for the Congress and White House to just let it kind of slide.
Yeah.
Without talking about it.
Right. Do nothing and you don't get in trouble.
Yep.
And you can always blame the other party, right?
Yep.
Oh my goodness. But you know, that's the webinar for today. A lot of good information here. If you want to go back to the previous webinar and kind of relook at some of the first three, I really encourage it. But that's all for today. You take care of your family and we will take care of you.